Hi all, welcome to my YouTube channel Banking Regulation Simplified. In this channel, you will understand the latest trends of banking regulation, understand in-depth concepts of banking regulation, and also you can use this YouTube channel to catapult your career in the world of banking regulations. Good luck. Hi all, welcome to our YouTube channel Banking Regulation Simplified. Today we will see overview of Basel III. Over the past few videos we would have understood on the world of banking regulations. Today we'll get slightly into the concepts. This will be an overview of the Basel Accords. Basel Accords had a linear path 1, 2, 3, 4. One was in 1980s, two was in early 2000, three was in around 2010. So the current regime of Basel Accords is anywhere between Basel 3 and 4. So I think it's better to for us to understand Basel 3 and Basel 4 rather than understand on Basel and Basel 2, because they're less sophisticated and less complicated compared to the sophistication and detailing of Basel 3 and Basel 4. And for anybody aspiring for a career in banking regulations, I think it is enough to know about Basel 3 and Basel 4. So in this video, we'll get to see on the overview of Basel 3, which will be a high level video, which will just touch upon the important concepts of Basel 3. In the subsequent video, we shall see in depth. Just in case if this slides or the document is not clear, I will attach a copy of the slides towards the end of the video. Now let's get into the video. Right. Okay. So I said in our earlier videos, we understood that BIS, BCBS are the primary bodies behind banking regulations, and aside to that, they were in the business of implementing regulations and promoting regulations right from 1980s. So it had a linear path 1, 2, 3, 4. That will be the path going forward. Probably 10 or 15 years later, we'll have another version of Basel known as Basel 5, which will touch upon certain important concepts or regulations, which will be together bundled called as Basel 5 by the regulatory fraternity. Okay. So now let's get into overview of Basel III. So Basel III was introduced around or in the aftermath of the 2007-8 crisis. So the banking regulators, the apex bodies, and the individual regulators of each country had learned their lessons and burned their fingers. So was this case with the banking industry as well. So it found out that banks had highly rigged the RWA calculation methodologies and had highly underestimated or underquoted the regulatory capital, which when things went out of control or during a full-blown crisis, the capital was not enough to take care of the bank's needs and led to the failure of certain banks like Lehman Brothers and Bear Stearns, and had a cascading and rippling effect across the banking industry. So BIS, BCBS, FSB were all closely working to resolve the situation. BCBS, like I said, is the think tank and comes up with the regulations to address the issue from a future perspective. So it had come up with a slew of regulations to address the issues or the gaps found as part of the 2007-8 crisis. On a comparative basis, the earlier publications on Basel II Accords was around 200-300 pages. On the same page, Basel III Accords was nearly 2000 pages. So you can understand the amount of detailing and the sophistication these regulations had carried. Okay, and what it did address? It addressed mainly the issues with capital buffers and bringing about a lot of ratios to handle liquidity crisis. And apart from that, it came up with a few more important regulations, which we shall see in the next slides. Now let's move on. So, like I said, it was introduced in 2010 by BCBS. The 2007-9 global crisis exposed several weaknesses. Banks' capital quality was not enough and good enough to handle crisis or absorb losses during a recession or a crisis. Excessive leverage. Banks had lent excessively and had quoted the RW and capital requirements for them by rigging the calculation models. And short-term finance funding reliance. Most of the short-term most of the banks faced an acute problem for handling short-term liquidity requirements, including some of the biggest banks, and that situation was handled through the FSB arm of BIS, but it exposed the short-term funding gaps of banks and lack of systemic safeguards, meaning banks had fully grown are tightly interconnected in the era of globalization. So any impact to a large bank to in any corner of the world will have a cascading effect or a snowballing effect. So this meant some systemic measures need to be devised to handle the issues from a large banks, which are called as GSIBs, globally systematically important banks. This list is maintained by FSB, Financial Stability Board, and released every year. Okay, so the bottom line is make banks more resilient to shocks through building capital levels, reduce systemic risk through identifying or putting certain additional charges for bigger banks, and protect the financial system. Now let's get into the details. Okay, so like I said earlier, the main focus was on increasing the capital levels. So simply setting aside one capital or one simple ratio was not enough to handle it. So they segregated or bifurcated the levels of capital into various categories and had set threshold values for them. Meaning, the minimum CET1 is high quality capital or the equivalent of cash or cash in itself, which will come good during any time of crisis. So that needs to be 4.5% of your risk weighted assets, and total AT1 is the additional tier 1, that's also as good as CET1, but the form and the shape will slightly differ in terms of the available instruments or the money or the instruments in which the money has been parked. So together they need to be at 6% of RWAs, and tier 1 and tier 2 are slightly lower quality or less loss absorbing capital forms, meaning the shape and the form in which the money has been or the capital has been parked will slightly differ and will have less acceptance value during times of crisis. Together they need to be at 8% of RWAs, meaning out of that 8%, 4.5% needs to be from CET1. CET1 plus AT1 need to be at 6%, and combinedly CET1, AT1, which is called as tier 1 capital, and tier 1 capital plus tier 2 capital needs to be at 8% of RWAs. So similar to Basel II, nothing much has changed. So they written the shape, but the improvisation was in launching of or introduction of few more buffers like capital conservation buffer, meaning 2.5% CET1, the first quality capital, meaning capital conservation buffer is when things go really bad and out of hand, rather than touching the 8% core capital which has been set aside as a last measure or as a last resort, the capital conservation buffer will act as a layer to handle the situation, which could be default, bank run, or handling liabilities, or paying for salaries or for maintenance. And on top of that is known as counter-cyclical buffer, which could be up to 2.5%. This counter-cyclical buffer is directly linked to the economic cycle, meaning when the economy is good, banks lend a lot. In other words, the economy is hot. When there is excessive lending, the next crisis is around the corner. So in this scenario, the counter-cyclical buffer will be kept as high as 2.5% to cool down or to slow down the lending and cool down the economy. And this high capital will be used when there is a crisis in the form of a default or a bank run, or let's say a bank failure. Then systematically important banks, like I said, it is also known as GSIBs, globally systematically important banks. This will have an extra capital surcharge of 1 to 3.5%, meaning this list of globally systematically important banks is released by Financial Stability Board on every year on an annual basis, and it also quotes the risk bucket of these banks and also tells how much percentage of capital they need to keep aside. So there are 4 or 5 buckets depending on the sophistication of the banking business of the respective bank and the risk in the banking model. So this also needs to be set aside, and this needs to be in the form of CET1. So what we see is a stack of ratios which will bring the total capital to anywhere between 16 to 17%, which is 8 plus 2.5 plus 2.5 plus 3.5, meaning 8 plus 2.5 10.5 plus 2.5 is 13, and plus 3.5 is 16.5. So the amount of capital required by banks has increased from 8% to somewhere between 16 to 17%, meaning So banks, even if they rig the amount of risk in their models and reduce the capital, they still need to set aside so many other ratios of capital, which will bring up the level of capital set aside in the bank's balance sheet. Bottom line is higher quality and which is equity heavy and quantity extra buffers of capital. So this is a game changer, meaning from 2004 to 2010, between the two iterations of the Basel Accords, or between the two versions of Basel Accord, the amount of capital need to be set aside has been increased from 8% to 16%, meaning 100% increase. And this did impact banks and to some extent slow down lending, but help banks handle any crisis. And the COVID-19 crisis is a tribute to this fact. The next is leverage ratio. The formula is simple. Exposures is the total amount of loans are outstanding. RWA is a byproduct of it, and capital is a ratio of the RWA. So you can rig the RWA value through sophisticated models, and as a result, the capital could be quoted less, which is a percentage of the RWA. So what leverage ratio did is, it's a game changer under Basel III. What it did is, it linked the tier 1 capital to the total exposure and said it should be greater than or equal to 3%, meaning even if the capital, the risk quoted is less, the capital quoted is less, and banks look good on paper or on balance sheet, there is always a risk which will be never known or which will unfold during the next crisis. So the amount of capital basically needs to be set higher to handle all this lacuna in the process. So as a result, what was done is, the tier 1 capital was linked to the exposures and was ensured to be greater than or equal to 3%. So obviously it will dissuade banks from excessive leverage, and also even when they bypass through the loopholes in the capital ratio model, capital buffer model, they still have to keep a higher capital to meet the leverage ratio standards. So this is a game changer. Next is liquidity coverage ratio. So all banks had short-term lending problems, short-term liquidity problems during the 2007-8 crisis. So this is a ratio which will directly address that issue, meaning each bank needs to hold high quality liquid assets to survive a 30-day stressed funding scenario, and that ratio is known as LCR, and that should be greater than or equal to 100%. That's basically a sum of the inflows and outflows of the banks. The next is net stable funding ratio. This is a ratio which will hold good when there is a prolonged crisis or a recession, meaning each bank needs to hold enough capital to take care of the liquidity requirements for a 1-year period or a 12-month horizon. So this ratio is known as net stable funding ratio. This also needs to be greater than or equal to 100%. Basically, it's a value of available stable funding, ASF, divided by required stable funding, which should be greater than or equal to 100%. So, and the systemic risk measures, which I said, extra capital for globally systematically important banks, which is a list released by FSB. Then introduction of macro-prudential tools, counter-cyclical buffer, which is linked or adversely linked or contradicts the economic cycle. When the economy is good, it is increased, and when the economy is bad, it is decreased. So what happens is, when the economy is good, banks set aside more capital, that slows down the lending, and when the economy is bad, this capital buffer is reduced, so they'll have enough capital or additional or some capital released through the reduction of these ratios, which they can use to lend or handle defaults or propel themselves back to normalcy. Stress testing and recovery resolution planning encouraged. So all this are part of the supervisory review mechanism, which we shall see in the next video. So it was announced in 2010, phased in globally between 2013 to 19. So like I said, in some of the important regimes like US, UK, it's still mostly in Basel III. They're yet to migrate to the Basel IV regime. So, and the next version is called as Basel IV or Basel III Endgame by the industry, and that implementation will stretch until 2023 or 28. In some geographies, it's stretching until early 2030s. So different countries have adopted different speeds. European Union via Credit Risk Directive 4, US Fed rules, RBI in India. So the Basel Accords is a publication from the BCBS that is circulated to its participating members who then customize or interpreted that for their own requirements, or slightly customize it for their own requirements and release uh, that as a publication or a version of Basel Accords to their own jurisdiction. For example, Credit Risk Directive 4 is the implementation of Basel III for the European Union. Okay, what happened? So positive, stronger bank balance sheets. There can be no further rigging of RWAs and lower quoting of capital. Reduce systemic risk by keeping higher capital for globally systematically important banks. Better liquidity management, more trust in banking system, which was evident during the COVID-19 crisis. Challenges: higher capital requirements, reduce return on equity. It's a point accepted, but whenever there is a crisis, it shaves off so much percentage, let's say 5-10% of GDP, and pulls back or eats so many years of growth. So that, compared to that, setting aside higher capital and slower growth or probably reduced growth to some extent is better, lot better. Compliance costs are significant. Yes, I said there's a lot of detailing and sophistication that needs to be read, interpreted, implemented, which would mean that there's a huge requirement or cost from a software or hardware or a manpower cost. And some argue it may restrict lending during recovery phases. Yes, right, point taken. But recovery phase is not only about reducing dabbling with the capital ratios. It's more about fundamental recovery of the economy and banks being stable and alive. So this is a snapshot of the comparison between Basel 3 versus 2. CET1 minimum 2%, it had increased it to 4.5. There was no concept of leverage in Basel 2. There was Basel 3 was introduced a concept of leverage ratio where it has to be kept greater than or equal to 3%. There was no concept of liquidity rules, whereas it had introduced liquidity rules like LCR and NSFR. No buffers. It had introduced a slew of buffers like capital conservation buffer, counter-cyclical buffer, and systemic important banks, GSIB charges for globally systemic important banks 1 to 3.5%. It did not exist in Basel 2. So that's a sneak peek about me. So we have come to the end of the video. Hope you like the video. For more such videos, stay connected. And like I said, I'll share a copy of the slides towards the end of this video. Thanks for watching. Good luck. Bye.